Good morning, everyone. Welcome to the market opening bell for Tuesday, March 31st, your 10-minute guide to the stock market. The Houthi armed group in Yemen has confirmed that it fired missiles at Israel. This marks the first time the group has done so since the current Iran-related conflict began, signaling its formal entry into the conflict and raising the risk of further escalation in the situation. Oil prices rose with WTI crude breaking through the $100 per barrel level. Hong Kong stock futures were on their last trading day, and the morning session followed the weaker performance of overseas markets. The Hang Seng Index opened 419 points lower. It fell as much as 542 points in the early session to 24,409 points. Later, reports emerged that U.S. President Trump said indirect negotiations between the United States and Iran conducted through intermediaries in Pakistan were progressing smoothly and that a ceasefire agreement with Iran may be reached soon. The decline narrowed with the index reaching 24,811 points, down 140 points. It eventually closed at 24,750 points, down 201 points or 0.8%. The X-share index fell 54 points or 0.65% to close at 8,399 points. The Hang Seng Tech Index dropped 87 points or 1.8% to close at 4,690 points. Total market turnover for the day was 285.4 billion Hong Kong dollars. Southbound funds recorded a net outflow of 2.467 billion dollars from Hong Kong stocks. Among them, net buying included Tencent at $608 million and Sunce at $104 million. Net selling included Tracker Fund at 3.846 billion, CSOP Hang Seng Tech ETF at 1.338 billion, Hang Seng China Enterprises Index ETF at 1.184 billion, Alibaba at 874 million, SMIC at 498 million, Yangtze Optical Fiber and Cable at 360 million, Popmart at 337 million, and Meituan at 181 million. According to statistics, Southbound funds have been net sellers of SMIC for 11 consecutive days, totaling $5.013 billion. They have also been net sellers of Alibaba for 3 consecutive days, totaling $2.528 billion, while continuing to net buy Tencent for 3 consecutive days, totaling $1.169 billion. The 3 major A-share indexes opened lower but rose later in the afternoon in the session. The Shanghai Composite Index closed in positive territory, while the Shenzhou Component Index and Chinex Index saw their declines narrow significantly. The Shanghai Composite Index rose 9 points or 0.2% to close at 3,923 points. The Shenzhou Component Index fell 34 points or 0.3% to 13,726 points. The Chinex Index dropped 22 points or 0.7% to 3,273 points. Combined turnover in Shanghai and Shenzhen markets reached 1.9198 trillion yuan. The central parity rate of the renminbi against the US dollar was set at 6.9223, down 82 points from the previous day. Innovative drug concept stocks in the Hong Kong market mostly rose. On the news front, in the first 3 months of this year, the total value of overseas licensing deals for Chinese innovative drugs exceeded $60 billion, nearly half of the full year total for 2025. The latest statistic from the National Medical Products Administration showed that as of March 27, 10 innovative drugs have been approved this year, 2 imported and 8 domestically developed. Chinese innovative drugs have achieved a historic breakthrough and maintain strong development momentum and potential. Hong Kong listed photovoltaic stocks fell across the board according to announcement number 2 of 2026 issued by the Ministry of Finance and the State Taxation Administration. The 9% VAT export rebate for photovoltaic products will be fully cancelled starting from April 1st to 6th. This means the era of multi-year photovoltaic export subsidies has officially come to an end, and the industry will shift from policy-driven to market-oriented competition. Industry insiders generally believe that the immediate impact of the rebate cancellation, falling prices across the industry chain, and strong wait-and-see sentiment at the end-user level will combine to make second-quarter earnings for photovoltaic companies unlikely to be optimistic. It's worth noting that there was no expected rush to export surge before the policy took effect. Export data for January and February remained stable, while polysilicon prices instead fell to a new low of 40,000 yuan per ton. Sources indicated that during a performed briefing with analysts, BYD management told attendees that the company is confident of achieving 1.5 million vehicle exports this year. The figure is higher than the 1.3 million overseas delivery target disclosed by the company in January. Last year, BYD's overseas deliveries totaled 1.05 million vehicles. Agricultural Bank of China announced its full-year result for the period ended December last year, with net profit growth leading the big five banks. Revenue for the period was 725.1 billion yuan, up 1.9% year-on-year. Net profit reached 291 billion yuan, up 3.2% year-on-year, with earnings per share of 0.78 yuan. A final dividend of 0.13 yuan per share was declared, compared with 0.1255 yuan per share in the same period last year. The full-year dividend was 2.495 yuan per 10 shares, with the cash dividend payout ratio remaining stable at 30%. Net interest income for the period was 569.5 billion yuan, down 1.9% year-on-year. The net interest margin was 1.28%. The net interest spread was 1.16%, down 14 basis points and 11 basis points respectively. This was mainly due to the impact of LPR cuts and low market interest rates, which caused a decline in the yield on interest-earning assets. The narrowing of interest margins is a common industry phenomenon, but Agricultural Bank benefited from its low-cost funding advantage in county-level finance, resulting in relatively stable performance. Net fee and commission income was 88.085 billion yuan, up 16.6% year-on-year. The non-performing loan ratio fell 0.03 percentage point to 1.27%. Bank of China announced its full-year results for the period ended December last year. Despite facing macroeconomic pressures, the bank still recorded moderate profit growth and maintained stable asset quality. Revenue for the period was 659.8 billion yuan, up 4.3% year-on-year. Net interest income reached 440.7 billion yuan, down 1.83% year-on-year. Net interest margin was 1.26%, down 14 basis points year-on-year. This was mainly affected by the downward adjustment of the domestic RMB loan prime rate, LPR, and the declines in foreign currency market interest rates, which caused the average yield on interest-earning assets to fall 49 basis points year-on-year. Non-interest income was 219.1 billion yuan, up 19.21%, showing strong performance. Non-interest income accounted for 33.21% of total revenue, remaining at a relatively high level. Net profit was 243 billion yuan, up 2.2% year-on-year, with earnings per share of 0.74 yuan. The final dividend was 0.1169 yuan per share, compared with 0.1216 yuan per share in the previous financial year. Together with the interim cash dividend of 0.1094 yuan per share already paid, the full-year dividend totaled 0.2263 yuan per share, compared with 0.2424 yuan per share for the previous financial year. The non-performing loan ratio improved slightly to 1.23% from 1.24% at the end of September 2025. Bank of China Vice President and Board Secretary Liu Chenggang said that last year the bank's net interest margin was 1.26%, down 14 basis points year on year. It has stabilized and begun to recover in the second half of the year, remaining flat compared with the first half, while net interest income also grew both year on year and quarter on quarter. Looking ahead to 2026, he expects the year-on-year decline in net interest margin to narrow significantly, and net interest income is expected to achieve positive growth. When asked about domestic deposit growth, Vice President Yang Jun said that M2 deposit volume has maintained growth in recent years, with an average annual growth rate of 8.5% over the past 3 years. He expects this trend to continue this year. Last year, the bank's domestic renminbi loans grew year on year and pricing also improved. Since the second half of last year, the volume of maturing fixed-rate deposits has increased. The bank has focused on stabilizing and retaining deposits, with most still retained in deposit form. The situation for maturing fixed-rate deposits this year is expected to be similar. BOC Hong Kong announced its full-year result for 2025 under challenging macroeconomic conditions. It demonstrated stronger growth momentum than its parent bank, with both net profit growth and dividend levels improving. Full-year net profit reached 40.121 billion Hong Kong dollars, up 4.9%. The board implemented quarterly dividends in 2025 and proposed a final dividend of 1.255 Hong Kong dollars per share for 2025. Together with the 3 previous interim dividends, the full-year dividend per share totaled 2.125 Hong Kong dollars, representing a 6.8% year-on-year increase. The payout ratio was 56%, up 1 percentage point. Net operating income before impairment allowances for the year was 77.019 billion Hong Kong dollars, up 8.1% year-on-year. Net interest income was 59.211 billion Hong Kong dollars, up 1.1% year-on-year, while the net interest margin fell to 1.4% from 1.46% in the same period last year. Last year, net provision for impairment allowances on loans and other accounts amounted to 8.248 billion Hong Kong dollars, up 66.8% year-on-year, mainly due to the continued weakness in the commercial real estate market and the downgrade of internal ratings for certain real estate industry clients. Shenzhou International fell 8.1% to close at 48.04 Hong Kong dollars, making it the biggest decliner among blue-chip stocks. The company announced its full-year results at midday. Although revenue broke the 300 billion yuan mark for the first time, profit declined due to exchange losses and rising costs. Revenue for the year was 209.94 billion yuan, up 8.1% year-on-year. Net profit was 58.25 billion yuan, down 6.7% year-on-year, with earnings per share of 3.88 yuan. A final dividend of 1.2 Hong Kong dollars per share was proposed, compared with 1.28 dollars per share in the same period last year. Together with the interim dividend of 1.38 dollars per share already paid, the total proposed dividend for 2025 is 2.58 dollars per share, up approximately 2% year-on-year. The payout ratio for 2025 was approximately 60.9%. Gross profit margin for the period was approximately 26.3%, down about 1.8 percentage points year-on-year. 2 new stocks will be listed on the Hong Kong Exchange today. 4 Semi, stock code 3625, closed at 84 $44.60 in the grey market on Philip Mart yesterday, which was 111.5% or $44.60 higher than the listing price. Excluding handling fees, each lot of 100 shares generated a paper profit of $4,460. Tong Shifu stock code 664 closed at $42 in the grey market, which was 30% or $18 lower than the listing price. Excluding handling fees, each lot of 100 shares recorded a paper loss of $1,800. Technical analysis, the Hang Seng Index briefly broke below the 24,500 point level but recovered to close above 24,700 points. This shows that 24,500 points has support, while 25,000 points is acting as resistance. Federal Reserve Chairman Powell said on Monday that although energy prices have risen, inflation expectations are expected to remain stable in the short term. Data from the CME Fed Watch tool shows that the Federal Funds Futures market has lowered its expectations for Federal Reserve interest rate hikes this year, and U.S. Treasury yields fell significantly. However, Iran has imposed transit fees on the Strait of Hormuz and banned U.S. and Israeli vessels from passing through, causing oil prices to rise further. This led to a sharp decline in U.S. technology stocks. The Nasdaq index fell 153 points or 0.7% to close at 20,794 points. The S&P 500 index dropped 25 points or 0.4% to close at 6,343 points. The Dow Jones index edged up 49 points or 0.1% to close at 45,216 points. The Fear Gauge VIX index fell 0.4 points or 1.4% to 30.6. The Nasdaq China Golden Dragon Index, which reflects the performance of Chinese concept stocks, declined 23 points or 0.4% to close at 6,569 points. Memory chip stocks led the decline. Micron plunged 10%, while SanDisk and Western Digital also fell 7% and nearly 9% respectively. Google recently announced a new compression algorithm called TurboQuant, claiming it can reduce the memory requirements of large language models by up to 6 times. The market is concerned that this breakthrough will significantly improve AI efficiency and thereby reduce overall demand for hardware such as high bandwidth memory, HBM, triggering collective anxiety among investors about whether the supercycle in the memory sector has peaked. In addition, key raw materials required for chip production, such as helium, face supply disruption risks due to restricted access through the Strait of Hormuz. The market is reassessing the risk of cyclical oversupply if demand weakens, especially given the high capital expenditure involved. For instance, Micron's annual spending exceeds $25 billion. In other technology stocks, Nvidia fell 1.4% and Apple dropped 0.9%. Meta bucked the trend and rose 2%. Morgan Stanley reiterated its overweight rating on Meta with a target price of $775 and named the company as its top pick within its coverage universe. The bank noted that although investor sentiment is at the low, Meta's core digital advertising business remains in good shape. It forecasted Meta's annual advertising revenue will grow 28% in 2026 and 21% in 2027, both higher than market expectations. Our stock pick today is INNOCARE, stock code 9969. In 2025, INNOCARE achieved transformative growth. Total operating revenue reached approximately 2.374 billion yuan, representing a substantial year-on-year increase of 135.3%. Among this, revenue from drug sales amounted to 1.442 billion yuan, up 43.4%, mainly driven by strong sales growth of orelabrutinib and the new launch of tanezumab starting from the fourth quarter of 2025. Revenue from business collaborations reached 904 million yuan, primarily from licensing income generated under exclusive licensing agreements signed with Senes Biopharma and Prolium. The group recorded its first ever full-year profit of 644 million yuan in 2025, compared with a loss of 452 million yuan in 2024, achieving a significant milestone. This was mainly attributable to strong commercial execution, improved market penetration of its launched products, and the realization of value from strategic global business development partnerships. Gross profit margin rose to 92%, an increase of 5.7 percentage points from 86.3% in 2024, largely due to the contribution from business collaboration revenue. With multiple products either already commercialized or about to submit regulatory applications, INNOCARE has entered a new stage of diversified growth. This has not only enhanced the predictability of its profitability, but also expanded its global business footprint. According to INNOCARE's 2.0 strategy, globalization was a core strategic focus in 2025. The group completed two milestone business expansion transactions, significantly broadening the international layout of its pipeline and its value realization pathways. In January 2025, the group entered into an exclusive licensing agreement with Prolium for the development and commercialization of ICP-B02. Under this agreement, Prolium obtained exclusive rights to ICP-B02 for all non-oncology indications globally and for oncology indications outside Asia. In October 2025, INNOCARE reached a strategic licensing collaboration with Senes Biopharma, granting Senes exclusive rights to develop, manufacture, and commercialize orelabrutinib and commercialize and for the treatment of multiple sclerosis globally, as well as for non-oncology indications in regions outside Greater China and Southeast Asia. INNOCARE retains full rights to orelabrutinib in the global oncology field and rights for non-oncology indications in Greater China and Southeast Asia. This collaboration also grants Senes exclusive rights to develop, manufacture, and commercialize an oral IL-117AA/AF inhibitor in regions outside Greater China and Southeast Asia, as well as exclusive global rights to develop, manufacture, and commercialize an oral brain penetrant TYK2 inhibitor. These transactions demonstrate the global competitiveness of the group's innovation engine and clinical assets, while enabling it to leverage its partners' international development and commercialization capabilities. Looking ahead, globalization will remain a core pillar of the group's strategy in 2026 and beyond. The group will continue to focus on selective out-licensing, co-development, and regional collaborations, while maintaining its strategic focus on innovative assets to maximize global value. The group's self-owned 83,000 square meter small molecule manufacturing facility in Guangzhou complies with GMP standards of the United States, Europe, Japan, and China, and has an annual production capacity of 1 billion tablets. It has already successfully obtained the production license. The facility has completed Phase 2 and Phase 3 construction, adding a total of 21,541 square meters of production area. The Phase 3 construction will support the rapid growth of orelabrutinib and the upcoming launch of new products. In addition, the group has established a large molecule (CMC) stands for Chemistry, Manufacturing and Controls pilot facility in Changping, Beijing, intended for the operational phase of early clinical supplies. It has also selected a 70,381 square meter plot of land adjacent to its headquarters in the Beijing Life Science Park to build a landmark R&D center and large molecule production facility. Recommendation: buy at 13 Hong Kong dollars. Target price $14.50. Stop loss $12.20. I do not hold the above stock.